we're going to update everyone on the first weekly reversal of the new year. So basically, I'll blow up this part of the chart. This is January of 2011 move. And we got right up here at the top, and we are about to break half of this weekly bar right there. And a close below that weekly bar, and we'll take half of this narrow range weekly reversal last week on the S&P 500, and I closed below half of last week's bar. So let's make sure what that's related to. That's this bar. This is the low at 1270, and that was the bounce on the S&P. We've been talking forever that the standard public indicators, such as the MACD at 44, that's at an all-time high. We talked about the fact that the percent DS was at 97. We've had high readings up here where markets have corrections and markets have pullbacks. We're going to be watching the S&P reversal. If we have an S&P reversal, then we're going to go right over here to these bear funds, and we're going to start taking a look at the ultra short one right here. That's this S&P 500, and we're going to take a look at the bear fund compared to the S&P index itself. When we get down to really doing our work, we can tell how far we've ran to this January top. We can see that the bear has been totally mutilated over the last from 2009 period. That's what happened to the bear when we've had this long, almost 24 months into the tooth of this rally. We have gotten to very extreme lows on the bear, and that's an S&P 500 ultra short, the SDS. So basically, when we're going to have market corrections, we take a look at each pattern of the S&P 500. The S&P 500 still has more room to go, just that they didn't treat it well, and there are tops that can get up above here in that S&P 500. 1320 is our upside on the S&P, and the lower end is that the S&P doesn't have any good support until we get all the way back down here. This is going to be right around, let's say 12, let's call it the 1220 area right here, 1221.39. So that's where the base of the end of the 09 light volume rally took place. This is the 3-week move. That's 15 days of trading of 2011. And there we are. So basically what we're going to be watching is if we gap below half bar and we start to see daily selling, then we're going to go right back over here and we're going to start looking at how to buy the bear, because that would be another way of using that instrument to get part of that movement. So this goes up and this goes down in value. Naturally, that bear goes up in value, and that's the SDS that we'll be looking at. So there are other ones that we're going to do outside of the S&P 500. There are several other ones. Here is an S&P 500 short. It just doesn't have that much volume. However, and it costs more money, and this one here is called the SH ProShares Trust, S&P 500. It's not a 3X or anything like that, but once again, we are at all-time lows and we have an uptick. So the thing about corrections is that when you get too overbought in the short term and too oversold here on the short term, we're going to see that if that gaps down, that's going to push that SH. It's related to the S&P 500. There's the S&P 500 index. So that's how we're going to take a look at trading that S&P 500. Okay? And we'll look at another thing that we're looking at is this is a 23 million shares here versus the other one that's in here. That's not quite the volume this one here is. This one is at $21. None of the bear funds have been beaten down as bad in a very long time. Perfect for market type corrections. So the S&P has a weekly reversal, and basically it's past number one only. So if we don't set up half of this bar and consolidate to move higher, well, guess what? Then if we do, we won't buy that bear. But if that bear gaps down below half of last week and becomes new resistance, and we have daily selling like we had during the first earnings of last week, then we'll be buying that bear aggressively.